Thank you very much for having me today. It's a very big honor and pleasure to present to everybody today. This is something which ATB and myself I'm very passionate about. I am very passionate about renewable energies, clean energies, and big projects. I've loved it as a kid, but then I also have quite a bit of passion over in terms of actually helping plus Indigenous groups. So this is a great marry of both of them, and I look forward to presenting to you guys today about it. I won't bore you too much. I'm sort of required. I see William Vu there, so he can put a check mark that I've done my corporate responsibility and talk about ATB here very quickly. So ATB, what makes us different? We're actually owned by the Alberta government, so we're a crown corporation. It makes us a little bit different and than others that you may deal with over in terms of uh, financial institutions, but we are primarily engaged, at least the team which I'm part of, over in what we call project finance, which is basically financing a bunch of very big projects, as it basically sounds like. We've done hydro dams, railways, roads, hospitals, power plants, and such. And we also provide very specialized advisory services over in there because it's one of those things, financing big projects can be complicated, and there's a really specialized niche over in that world, and we actually do a great job in that. So that's one of the things that we also provide is the advisory, bank lending, and other things to basically help a lot of people get these big projects through. About me, done a lot of deals. I'm 18 plus years. I know my Asian good looks sort of keep me look like as though I look very young, but I've been doing this forever. It feels like. But maybe in terms of just what ATB has done, we are the number one financer over in renewable projects here over in Alberta. We've done the most, especially in the last several years, and we've been pioneers over in many aspects of the financing over in this. As Furman and everybody else has alluded to, we've also been over in the privileged position to actually help out as well, especially with the AIOC and plus some of their initiatives. We've been involved with 3 out of their 4 deals. We've also provide advisory to several First Nations as a result of those AIOC capacity grants as well. So this has been truly a great time because and you'll hear it later on because we sort of talk about it, but it's a great time in terms of for economic reconciliation. I think it's a very unique time to be in because governments are stepping up, people are stepping up, industry is stepping up, and everybody's stepping up over in terms of providing more opportunities for economic reconciliation. And one of the biggest things that we do see here is also the need for the capacity. And so people like us are typically hired by groups from either side to basically help build that capacity, build awareness, and to ensure that people are getting the right deal and such. One of the things I would highlight here as well is that typically, if it's a deal that fits AIOC, typically why people sort of like us is that we're engaged over by the AIOC capacity grants, and usually comes at little to no cost out of folks to have us engaged to really represent them. And really, what makes us really good as an advisor is we have a lot of experience over for doing these deals. Specifically, given the number of AIOC deals which we have done, really it provides for execution certainty. So getting across to the finish line, but also as we've highlighted as well, we do so much solar, renewable winds over in Alberta. We do oil and gas. We do everything else, pipelines and such. We have a significant amount of experience in Alberta, and you're also getting that as well. So other than that, that's a bunch of stuff which I yet again am required by somebody to say that we do a lot of stuff. But yeah, we do a lot of stuff. But maybe then sort of going over to this, and this is sort of the heart of the presentation. And I apologize for the boring part because like everybody else over in school, learning terms and definitions wasn't the funnest part. So I'll try to make this fun and exciting as best as I can over in this. But to understand sort of renewables financing for renewables, we do need to pay attention to a few different terms that may be different for some people and to focus in on. So the first term and probably the most important term for, and I'm going to speak to the Indigenous groups here over on the call, I'm going to imagine that you are the investor You are the owner and you are the person who's getting the upside. What do you care about the most? It's a thing called IRR, typically, is what most investors care about. It stands for internal rate of return, but it basically calculates what type of return you're getting about. So people say, oh, I got a 20% return in the stock market, 5% return over on my mortgage. Actually, that's what the bank says. That's me. Sorry. Not you guys. But, everybody says, hey, I get a return on something. IRR is a very simple thing to sort of say is like, what is your return on average per year, basically, right? But it's also very useful when you have different opportunities which you're looking at. So the example I sort of put here, you may have two different projects which you can invest into. Both of them cost $100, but one is for a longer term in time where you get $30 a year. Another one may be shorter, but you get $50 a year, but you get shorter. IRR is a good way of sort of saying which one gives me a higher return per year. That's a good way of looking at it. And sometimes a lot of people use that to help them determine what is maybe a better investment or not. And as an equity owner and as an owner of a future, let's pretend this renewables project, sometimes people care about getting a higher return, but sometimes people also care about getting more money here. So you can see like, hey, you got $30 for each year for 4 years, you get $120, or for 5 years, actually for $150. In this one, you get the total returns here for 150. They sort of tie back to the same, but this is a longer period of time. That may not be a good use of your money, but sometimes people like getting returns over a longer period. So this may help you decide, but in this example here, Project B, because the returns come higher and in a shorter period of time, that has a higher IRR. And a lot of investors would pick Project B because it has a higher return in a shorter period of time. So that's an example of IRR. The next two are boring ones, but it's the ones that me as a banker sometimes and the banking guys really love. It's called debt service coverage ratios. Most equity people and most investors hate this term, and because it's really for us, and then the best way for me to sort of characterize this, a debt service coverage ratio is a measurement of risk. As a lender, and I can pretend to be the bank here because I can't keep on pointing to William over in the conversation. But as a lender, we care about risk. We have no upside, so if your investment goes very well, we don't make the extra return with you. The only thing we have is downside. So if your investment doesn't turn out the way that you expected, we share the same downside risk as you. So what we sort of look at is, well, how good is that return relative to various things? So a thing, debt service coverage ratio, which is very big in solar projects and wind projects and renewable, the best example I can give you is like a mortgage. So imagine that, if as a bank, let's say I require a thing called a debt service coverage ratio of 1.5 times, and you made $1,500 a year, it means that I can give you a mortgage, or $1,500 a month. I can give you a mortgage of $1,000 per month. And that's a way of figuring out how much can your mortgage payments be on every single month. And literally for a solar or wind project, we do that for every year for like 15, 20, 25 years. And we figure out what you can afford for a mortgage for that time frame, dependent on what this debt service coverage ratio is. So the best way for me to sort of describe it, and I'll make it not without vulgar language, think of it as your poop space. That's literally which I would sort of plus I would describe it. It is the poop space of where things can go off the rails, but you can still afford your mortgage payment. And that's why banks care about it. So that is my PG way of saying something that I would usually use something a little bit more exciting type of word. The other term, loan to value. Another thing which bankers like me and William sort of care about, and what ATB cares about, is it basically says how much of debt financing, or how much money is a bank going to lend you relative to the value of the asset, right? Yet again, this is another measurement of risk, which is what banks are really focused in on because we have no upside, right? And typically we like these loan to values to be as low as possible, and it means that we're taking less risk. That is one way, but if you're too low, you're not competitive, and maybe another bank wins out on it. So, the market sort of finds its balance, and depends on what type of risk which you take, we will get to some sort of loan to value ratio. So let's say if you're investing in a solar project and it was worth $100 and we loan or $500 million and we loan 100, it would get to a loan to value of 20%. Other things, to sort of talk about from a key terms per perspective, and this is usually throws sometimes some people into a mind loop. The renewable power space, we do a lot of funding via a thing called special purpose vehicles. It sounds very weird, so let's just compare to what most people sort of know about. It's called corporations. A corporation is just like, let's make a corporation up. Let's make up a corporation called Geico because my name is Guy. And it has a bunch of different operations. I may do, I may be a farm, or, I may run a farm, I may run a renewable power plant, so forth and so on. When I go to borrow from a bank, the bank looks at all the different operations and all the different ways which I make money, the farm, the renewable power plant, etc. That would be how they would determine how much money to basically loan me over in a project. And that's a traditional way which everybody thinks about loans, is how much worth are you at, or how much worth do you have? But an SPV, which is what the typical way is done for a renewable project, it is only that solar or renewable or wind project. That's all they're looking at. And they're not looking at the farm that I have. They're not looking at Geico Corporation. They're only looking at plus the wind solar farm, that one specific thing which you're invested into. And that makes it different. And that's how predominantly, I'd say the majority, if not 75% plus of the financing in this renewable space is actually done. And it's a very specialized way. And go to the next boring thing. This is project finance. So this financing is called project finance. What makes it really different is sort of two things. One is it's typically used for very large value items, so $50 million plus. And I'll be honest, that's very tough. Usually it's $100 million plus. But that's sort of the type of size of projects which people look for before they use a thing called project finance. And really all they look at, going back to this analogy, we're only looking at how much, and we'll stick to this for the rest of the presentation's easy. How much is this solar project really going to generate over as money? So we're going to use a solar project throughout this as an example for the analogy, but how much does a solar project generate in terms of money? And they don't look at, going back to the Geico Corporation, they don't look at the farm I have or anything. They only look at this one solar plant. And whatever money that they think it's going to make is what they're going to loan to give to the project to finance it. So what makes this very unique is that it's non-recourse. So what does non-recourse mean? If this solar plant fails, the bank only can go after the solar plant. It can't go after Geico Farms and anything else. It can't go after the corporation. It's in terms of recourse, and what it can go after is only plus the solar plant. So this is very good because it protects, if something fails, it doesn't impact the rest of your ownership or your other assets. But if I did it as a corporation and it was financed as Geico Corporations and this solar plant failed, they can go after Geico Farms, which makes these beautiful tomatoes that I don't want them to ever touch. And that would be something devastating, right? So it's a good way to sort of manage risk so that if something fails, it doesn't impact the rest of the investments which you may have. And that's what makes this financing so unique. But what also makes it unique is basically these three bubble boxes. One is, and let me be very honest, lawyers love project finance. Most people sort of hate it. And let me sort of be very honest. Why? Because it's a lot of legal agreements and a lot of documentation. And, so I say that right here, a lot of legal. And we look at every element of a project and we try to structure it for low risk. So engineering and construction. So we heard about Trans Mountain, cost overruns again. That sort of doesn't happen in project finance because what people do is sign a fixed price construction contract. So we know what the price is, and if a cost goes over, that's the construction contractor's issues. It's not the issue for the project. And what does that provide? It provides certainty because we know how much that construction is going to cost. We're not going to pay $1 more. We're going to pay exactly what it is. But the construction contractor, what are they going to do? They're going to probably price the construction a little bit more because they have the risk if the cost goes over. That is their issue. So it may cost you a little bit more for the construction price, but you also know what you're going to pay for it. So you're getting certainty. And that's what everything is really about, managing risk to get to certainty. So that's one example in the construction side here. Operation sides, a lot of the things that we do is we sign long-term operation agreements. So we may have somebody, for the solar plant, mow the lawn, right? Because we don't want the grass to get too long and stuff. We may sign a 15-year, 20-year agreement with a company to literally mow the lawn over at the solar power plant, so we know what the cost is for the next 15, 20 years. We may pay a little bit more for that, but at least we know who it is and who's going to do it and for what cost. Yet again, we know what it is. It creates certainty. We may pay a little bit more for that, but we know what it is going to be for the cost of it for 15, 20 years. We will talk about a thing called a power purchase agreement. It's another way of getting certainty. We know how much revenue which we're going to make. And this is usually the other thing. So what do we do beforehand? So there's a thing called merchant or PPA, or let's go highly certain or low certain, merchant versus non-merchant. The whole job of project finance is to reduce risk. But what is the result is we get cash flow certainty. So it's more predictable. We know what it is. We're trying to make sure that it runs like a clock, and we know how much money we're going to get for every year way out in the future. But it comes at a cost. Nothing is free in life. Yeah, risk goes down, but you see this other arrow, returns go down. Sometimes people get very upset about that, but let me point that out. Returns do go down when you use the project finance structure, but there are also benefits from that, which we'll talk about. Mainly being that, hey, lenders are willing to provide a lot more money over into a project. And as an equity investor, you may need to only put a lot less into it to invest into it to make the project work. That's the rub. And that is very attractive for a lot of people sometimes. But then the other thing here is this: lower risk and higher certainty cash flows or higher certainty investments. The number of people in the world who will invest in high certainty, low risk investments is very big. So the biggest markets in the world are actually, and the biggest investors in the world all go after low risk, high certainty investments. There are very few people who go after what we call the angels, the home runs, where high returns but high risk, where I'm willing to sort of sometimes, and the casino analogy sort of gives you probably where it is. Let's go for red 50-50, upside, downside, that's it. Let's go for it. There aren't that many investors out there who go for high risk, high return investments. And as a result, when you have a lower risk and a higher certainty project, you can find investors a lot easier, and there's a lot more money out there to support projects. And that's a very big difference. And that's why a lot of people find it very hard and very difficult to find money for high returns and high risk investments, because there's just fewer people in the world who basically do that. What is project finance? Next thing here. Alluded a little bit to this, merchant versus PPA. And one of the things I just want to quickly show here as this, and I will show this. This is Alberta. So this is from the Alberta Energy System Operator, their annual report. And this is what literally power prices from 2013 to 2022 were. And this was just recently, they do their annual report. Notice this, what the price was in 2016, 2017, $18 and $22. People lost money. Power plants were not profitable in 2017. Let me tell you that much for a fact, right? But you can see last year and in 2021-22, $101 and $162 was the average price earned over for power. And to give you an idea of just how crazy it is sometimes over here, this is literally live as of 11 a.m. As of 10 a.m., which is what the time is right now here in Alberta. The Alberta Energy System Operator is willing to pay $53.64 for a unit of power. At 8 a.m., if you were so lucky to sell it at that time, they were willing to pay $364.11. It moves, it changes dramatically depending on what time of day you're in and such. And that is really the key here. And a great way of starting off to talk about merchant versus PPA is that power prices in Alberta, and what makes Alberta and the state of Texas very unique, is it can be anywhere from $0 to $1,000 an hour. It is called a merchant market. It's sometimes like rolling a dice. but not a 6-sided dice, a 1,000-sided dice, and it could be anything and everywhere due to a bunch of reasons. And people say, but Guy, it's been great the last 2 years. It's going to keep on going up and up and up. That is great if you believe in that. And if you want that, you can invest more. So you can sort of go and say merchant model. So what is sort of a merchant model? I'll describe higher risk, higher reward. That is literally what it is. And you're not going to track that much debt because there's less certainty over in that, right? So this is Exhibit A. This is actually sort of an illustrative example, but uses most of the data points over from the Alberta power for history for the last 4+ years. And you can see if you did a merchant model, this green line is how much you would have made as an equity investor. That's a big part of the pie. You made a lot. Your mortgage payments were very tiny. It didn't really mean much. Operational costs were nothing. You made a lot of money, right? But what differs from a merchant model versus what I'll call a PPA model coming up next here is when you invest over in this, the majority of the cost, let's say it's $100 to build this solar plant, majority of that $100 would have came from equity. So you would have had to put in most of the investment. Banks don't put in very much money, and institutional investors and other people don't put in much money over to merchant model projects. They may put in $20, $30 maybe over for that type of risk. And the banks also demand a higher return for risk. So you're not getting the cheap bank financing, you're getting the expensive bank financing. So it comes, so basically what I would say here, more risk means less amount of funding from the banks and from funders at a higher cost, and more of the funds have to be put by you. So you have to put more investment in, but there's a chance of making more money. But let me be very explicitly here as well. If you got the 2016, 2017, when I said it was $18, $20, you couldn't afford your mortgage payment. You would have needed to dip into your own pockets to pay for it, right? And that's the scary part. And that's where the banks get very afraid of the merchant model, right? And, why is it so high for the last 2 years? Let me sort of say, ESG. So Alberta used to be powered quite a bit by coal power plants. Literally, that is no longer the case. So this is how much power is being generated in Alberta as of this moment, which is this 10,331. And I know this is very small, and I apologize, but this is how much it is from coal. Coal was generating 820 megawatts into the grid right now. That used to be a number that was significantly higher, 5-10 times higher value several years ago. So coal has basically been cut out from Alberta. It's now gas and such, right? Coal was a bit cheaper, but we needed more greener energy. So you see that. That's one of the reasons why the last few years have gone up. The other one, let's be very honest, who could have in 2019 predicted a war between Ukraine and Russia? That sort of pushed things up too. Let's not kid ourselves. So there is some positive things which led to it. So there's some upside. Downsides could be, hey, if a recession comes, this power price could go down dramatically. Let's go to PPA model right here. So PPA model, lowers, more stable risk. You can see the mortgage payment. We're willing to lend up very close to what you're actually getting over to this. So you get a lot more debt. Over in situations like this, maybe out of that $100, lenders will only put up $60, maybe $70 worth of the cost of funding that project. And as equity, you may only have to put $30 or $40 in. That is the big difference. And also your cost of your debt is along one of the cheaper lines if it's structured the right way. And what a PPA is basically saying is that somebody's willing to buy that power from you at a fixed price for the next 10, 15 years. That's what a normal length of a PPA is. And maybe you get somebody willing to, over in this case, buy the power back in 2019 for $50 for the next 15 years. And what typically banks like us look at is, and what you should look at as an investor is, not every buyer of the power is the same. If it was Geico who was buying your power, I'm not a very stable entity. Or if it was Google, Google has all the money in the world, you probably prefer Google buying that power, not Geico. And you probably want to use signing that contract with Google would give a lot more confidence to funders and to yourself that you would get that $50 every single year. That's another important thing to think about. You're going to hear this term called P50, P90, and all of this other stuff. What is P50 and what is P90? It's just another way of probabilities. I love this stuff. I love stats over in high school and university. I understand maybe not everybody loves it as much as I do, but P50 is basically another way of saying expected outcome. As an equity investor, all of you guys here who are trying to buy this solar power plant, this is what you probably care about most. What am I expected to earn, right? And we go and say, hey, you know what? Coal power is never coming back. There's going to be more carbon tax. There's more emphasis on greener energy. Maybe one day in the future, there is going to be a lot less gas power plants, or they're going to limit the construction of new ones. Power prices is going to the moon, right? It's going up. And and when you look at forecasts, you can have that as call it a P1, power goes to the moon, right? Which is like 1% probability. 50-50 is sort of saying, hey, maybe some of it sort of does come down, where this is our best guess at what the future is. That's what a P50 is what people expect to happen. A P90 is the more conservative way, which says 90% of the time it's going to do this, it is going to earn this value, if not better. And you can see this over in here. The P50 price is this blue line here, and you can see the P90 over in here. This blue line is significantly lower than the one, the P50. So you can see right here, a P50, and this is just a made-up example, over here was $150, but over here a P90, sorry, was $150. A P90 over here was $250. So you can see people expect it to be higher, but a P90 is just saying a conservative estimate. 90% of the time I'm going to do better than this. 90% of the time we're going to do better than this $150 value. And all P50 and P90 is just a different way of looking at risk. Lenders care about this because we don't get any upside. Equity investors, which all of you guys are today, you care about this because that's what you're expecting to earn. And the P10 or the P1 is, oh, that's the upside. That is the bright, shiny day scenario. I haven't put that in there, but you may want to look and say, oh, how much can I add? What's the potential upside of the project? That would be a P10. So let's get into what a typical solar deal looks like right now in the province of Alberta and everything else, and wind. We're going to go and just basically sort of show you it's this. So technology risks, wind and solar. Not sure if many of you guys remember Rain Man. I remember seeing my first windmill. It was over in the movie Rain Man because that's all I really remember. And Tom Cruise just driving along and just cursing around as he had to turn around to go and plus go to Vegas. That's the first windmill that I've ever seen in my life. Not probably, maybe some of you guys maybe saw your first windmill then too as well. But that movie is super old. Tom hasn't really aged that much, but it's a long time established project technology. People know how windmill works. Same with solar. Solar has existed since our solar powered batteries. I know I had a solar powered calculator. I had one when I was in high school and in elementary. I'm sure other people as well. It's also been a very proven technology as well. So people don't view that as very risky. We see it as a low risk type of thing. What do they typically look at in Alberta in terms of PPA and merchant? That's the big thing, which we were also talking about as well. It's a mix. And this is what they typically sort of look like. What you see for people is that, hey, we may get a PPA deal and a power purchase agreement for the first 10 to 15 years. So in this example I do here is like, okay, first 15 years, you're getting a PPA. And in this case, I think it's like $60 or something like that right here, right now, right? So you've got 60 years. That's what a lot of projects do because they want to track financing. So it's like a mix. And you can see right here, the amount of debt right here, it's very high. It's higher than in this, what we call the merchant phase, right? Where we expect the value of power prices being a lot higher and what we can earn, the green thing, a lot bigger. And the green here is what you get back as the owner of the solar project to be a lot higher. But during this initial phase, especially when you're paying off debt, you're probably having not as much distributions to you as an owner. So the first thing that usually catches a lot of people off guard is like, why am I making nothing in the first 15 years? It depends on how you finance it. You may, going back to those other examples earlier, if you invested a large amount of equity into it, you may be getting a lot higher equity returns here if it was a pure merchant model. But you may also have bad years like 2016, 2017, where basically power prices were basically low. You may not get any returns. You may be putting in extra money over into the project. But I would say most projects which we see here over at ATB sort of follows along this line where the first 10, 15 years, they sign a power purchase agreement with some proven entity like a big tech company out of the US. And they get a very certain rate of returns. Lenders like it, so we lend most of our money over in the first 15 years, and we're counting on the mortgage payments during the first 15 years to sort of mostly pay off most of the mortgage back. So, you may have started with over, using $100, and we wrote a $70 mortgage over in it. Probably about, that mortgage is no longer $70. It's probably with maybe $20 or $15 left by the time at year 15. And then maybe in the last 5 years, you pay off that last little bit of the mortgage owed over on the solar plant. But at that point, when you get to merchant phase, and lenders, we don't really like taking on too much merchant risk, but it depends. It has to always make sense. But by that point, PPA has come off and you go, woohoo, we're now a merchant project. And you could end up making a lot more over on this. So you can see this big green bar would be an example of what you would make with the merchant aspect of it over at a later point in time. So this is what a typical project looks like. The other thing I should probably highlight here is operating cost for a solar farm is not very much. You can see this orange line. It's consistent. It's very little. Most of the money earned over on a renewable project like solar and wind, most of the money is used to repay back the investors, the debt and equity owners. Cost for running one is actually not significant, especially over in a solar project. So that's right there. Payback, it's not like an investment over with, let's say, a higher risk investment where you may get paid back in 1 or 2 years. Typically, you don't pay off the cost of the solar plant for 10 plus years. I go even 15 plus. It's a very aggressive market. A lot of people like solar right now just because of ESG and such. So a lot of people are very attracted to it. And as such, we typically see equity returns on an average project right now being less than 10%. So that IRR number, which I said, most investors are willing to accept something less than 10% in Alberta for a mix of PPA and merchant right now. So it's not a high return type of investment, but they're typically structured to limit the risk. Other parts that I need to talk about is finding a finance partner. When should you talk to an advisor? Whenever you start negotiating ownership of a project, you should probably get somebody to help be on your side, especially if you don't have much familiarity or experience negotiating, plus for a partner and what to look for. Things that you want to sort of see for experience is local experience and experience with renewables. Alberta is a funny market, just like Texas. They are the only two merchant markets in Canada and the US, and it makes for very different things. If people say that they've done a lot of solar projects over in Ontario, they don't understand the Alberta market, because Ontario, you just get a price from the government. It's very easy. There's none of that wavy line, which we talked about. Alberta, it's all about the wavy line. So it's a very big difference. And market changes very quickly, just as you can imagine. Carbon regulations and stuff has changed quite dramatically. Even with the lack of coal power plants in Alberta changed dramatically. So you really want to emphasize people who have experience within the last two years would be another thing that I would look for. Typically, what do you bring when you try to talk to a partner, an advisor, or to the bank when you need to go for money? You would look for what I call a project information memorandum. It's a comprehensive document that tells you, all the different aspects of the deal, like how the construction is done, how the operation is done, so forth and so on. And what are the returns that people expect? What risk are you taking? What risk has been mitigated? And really trying to encourage people, hey, this is what the expected returns would look like and such. So it's a very detailed document, 20, 30, 40 pages, typically, depending on length, but describing all the material aspects of how the project would be run. Like, you would tell you who's going to construct it, and they're going to construct it at X price, so forth and so on. So it's a detailed document like that. What else would you bring along is what we call a pro forma model, which is just basically a financial model, just like what I use to sort of create this wonderful chart right over here. But basically, that outlines what are my revenues, what are my costs, how am I going to fund the project, and typically it projects it all the way from the beginning of construction all the way until the end of the life of the project. So a 35 plus year projection over on your costs, revenues, and such. And this enables people to calculate what returns are and allows people to evaluate risk versus return, which is one of the biggest focus which we have. I'm going a little bit long here, but I just do want to do a 2 minute or 3 minute thing, and I'll get through this last part here, and I'll open myself up for questions. Was at ATB here, we're also very passionate about indigenous and indigenous investments and how the market is. I'll be honest, I think industry is behind over on this, and they need to basically think about better ways of dealing with indigenous group. We take a very big view that the attitudes has changed, and they better change now, because indigenous groups add a lot of value, which historically in the past, industry has not looked at it that way. They're like, it's a cost of doing business. We will, and the historical model is, hey, we'll lend them some money so they can have maybe some ownership, or we'll just give them some sort of token economic benefit to just get the project done. That is no longer the world which we are in. Indigenous groups add tremendous value on projects, and industry sort of needs to wake up about that. And what we sort of see as the big value add for indigenous groups are the following. One is, there's a lot of stuff set up like the AIOC. I know the feds and everybody else, everybody's trying to set up more things to enable indigenous investments for economic reconciliation. But the AIOC models and other models which are sort of done right now, and where I think the initial investments are going to be focused on, is sort of in that project finance sort of type of scope, where let's limit the risk. Returns may be lower, but it's more certain. And the benefit for that is with more certain returns, hey, if you have an investment that has certain returns for next 20, 30 years, for indigenous groups, you can plan and actually have a real budget. You can actually lend and borrow money off of that. You can actually plan for the future. So that's one of the biggest things. And these government grants, programs and stuff, they're really designed to create benefits for the indigenous groups involved. And what does that translate to industry is, hey, indigenous groups have a lower cost of funds, or to get money from indigenous groups is cheaper, but with a lower risk than relatively to what industry has to pay for. Let's call a spade a spade. A lot of people don't want to invest in oil and gas around the world. I'm not saying here in Alberta, but around the world. And as less investors want to invest in that, in order for them to get money from the market, it's more and more expensive. So they need to find other partners to help fill that gap. One. Two, let's be also honest here. ESG, economic, social, and governance. This is one of the biggest things. If you're not going to focus on ESG, I don't think you're going to get access to the bigger banks and bigger deals and to raise money in the big markets in the future, in the next decade plus, because everybody is going to need to focus in on that. So environmental, social. And when you do a project with indigenous groups, I sort of call it, it's like, well, you get two things. You get the E and the S. But if you're just purely building a carbon capture unit, let's say, and we will go carbon capture here because I think that's one of the biggest opportunities that you guys have, you only get the E. So you may as well hit both aspects, get that reward from the market and do that. So that's another value which indigenous groups provide. Number 3 over here is probably the biggest one, and I think it really should have been number 1 here, but I didn't put the order very well. Project risk reduction. Having indigenous partners do reduce risk over on projects in a material way. As I go and say here, everybody in the world, at least I think the smart investors, they don't look at return and they don't look at risk separately. They look at them together. So if I can increase returns and lower my risks, that's what really people want. And risk reduction does add value to projects. And I think indigenous groups add a lot of risk reductions in the terms of one is, people don't talk about, but hey, it sort of hits the government, the government goals. If you can sort of do a project where, let's call it carbon capture and stuff, and you can help hit the government goal as well of in terms of basically reducing CCUS or reducing carbon, but hit their economic reconciliation goals as well. The government's more likely to support that project. They're likely to put in less roadblocks. They're likely to find the person who is doing the permit, not the one who's going to be very tough. They're probably going to put the easier person over in that role, and maybe you get a little bit of a smoother track to in terms of developing those projects and such. there's a lot of value that politically I think Indigenous groups bring along to reduce risk, and I think that's major. And Indigenous involvement can create a win-win-win from all the stakeholders, from the industry, Indigenous groups, and let's call the third one government, which people don't talk about too much. But if you can make all those align, I think those makes projects go a lot more better. And I call this the quasi insurance policy, but it's also going to be harder for the government to shut down projects with Indigenous groups involved. I'm just going to call a spade a spade. This may not be politically correct, but I'll just say that. And this is my horrible example. Maybe it's a good example. I don't know. But if you had an oil sands operation that had an Indigenous investor and one without, the one without is probably going to get shut down first before the one with the Indigenous investor. And if you can run that oil sands operation for a few more years, it's worth a lot more. And I don't think industry really recognizes that having a partner that can maybe help extend lives or provide some political cover is actually very valuable in a place where politics get more and more involved in daily operations of all these big projects around the world. So that's another thing. What industry really cares about maintaining operational control? I think you can create an Indigenous partnership where they do maintain operational control, with Indigenous groups being heavily involved in creating economic reconciliation. I call it the car rental Hertz model. And I'm going to tell you very quickly what the car rental Hertz model is basically, hey, and I'm going to pick on carbon capture here very quickly, is to sort of say, hey, it costs a lot. It doesn't add value to oil. But instead, what if Indigenous groups were a majority owner in a carbon capture project and they rented the carbon capture project back to industry? In that regards, just like the Hertz car rental model, hey, we bought the car, we'll rent it back to you, which is industry. I don't care if you are an Uber driver or a race car driver, do what you want, but pay us the rent for using that asset. And I think that can be a new approach that can allow for some economic reconciliation, create win-wins, and really get a lot more investments, money, increased knowledge, create a triple win for everybody involved, in which Indigenous groups can be a major investor over in large projects on a go-forward basis.